Hello everyone, I had to start buying the dip today from scratch, knowing what I know about this market, these earnings reports, the AI panic, and the way investors are punishing even decent companies right now. I would be very careful. I would not just buy something because the chart looks ugly. I would not say, oh, it is down, therefore it is cheap. That is how people turn a temporary dip into a permanent headache. Most people think buying the dip is about bravery. It is not. It is about diagnosis. You have to ask why the stock fell, whether the business actually changed, and whether the market is reacting to a real wound or just a scary headline. Today is Wednesday, May 6th, New York time. Comment below what day and date you are watching from, because a setup that looks cheap today can look very different a few sessions later. And quickly, if you value this content, support by subscribing and comment John A.G. Best below. That tells me you are here for original thinking, not recycled noise. Now here's the strange part. The broader market is not acting weak. It has been pushing around record territory helped by earnings strength and the AI trade. So when four individual names pull back in that kind of environment, you have to lean forward a little bit. Not because every dip is a gift, but because the crowd may be treating four very different problems with the same blunt instrument. Sell first, think later. So in this video, we are going to walk through AbbVie, SoFi, S&P Global, and Disney. Four different businesses, four different stories, four different reasons for weakness. But one common question underneath all of them, is the market overreacting? Let's start with AbbVie, because this one is probably the most misunderstood in a very boring way. And boring can be good. The market has had one simple story on AbbVie for years. Humira lost exclusivity. Biosimilars came in. Revenue pressure showed up. Growth became questionable. Case closed. Nice little Wall Street bedtime story. Except the story did not end there. Based on recently published numbers, AbbVie's newer immunology drugs are now doing real work. Skyrizi and Rinvoq are not tiny side projects. They are becoming the new engine while Humira keeps shrinking. The latest quarter showed strong growth from those newer products, while Humira continued falling because of biosimilar competition. That is exactly what you would expect in a transition. And the key word is transition, not collapse. Transition. Now, I am not sugarcoating it. Pharma is never risk-free. You have patent cliffs, pricing pressure, regulators, clinical trials, acquisitions that may or may not work, and competition coming from every direction. If you want clean and easy, healthcare will disappoint you. But if a company can keep producing cash, fund research, support the dividend, and push new products into the gap, then the market may be looking too much at the old problem and not enough at the new base. This is where dividend investors pay attention. AbbVie is not some pre-revenue story asking you to believe in a dream. It is a large healthcare company with cash flow, a real product portfolio, and a dividend culture. The yield is in the mid-single-digit area? No, not that high. It is closer to the low to mid-single-digit range, which is still meaningful in a market where a lot of growth stocks give you nothing but promises and volatility. And valuation matters. If you pay a rich price for a company in transition, you may wait years just to feel okay. But when the multiple compresses, when sentiment is still skeptical, and when the business is starting to show that the replacement drugs are working, that is when the setup gets interesting. So for AbbVie, the question is not, did Humira fall? We know it did. The question is, has the market already punished the company enough for something the company is actively replacing? If the answer is yes, then this dip may be less about fear and more about patience. Now let's move to SoFi, and this is a totally different animal. AbbVie is the steady adult. SoFi is the fast runner who sometimes trips over his own shoes. This stock moves. It does not politely drift. It jumps. It dumps. It makes people emotional. And that is why position sizing matters. If you buy SoFi like it is a utility, you are going to have a bad week eventually. But the latest sell-off is worth examining. According to the latest publicly available filing, SoFi reported record net revenue a little above $1 billion, positive net income, strong member growth, and a product base that keeps expanding. Members are now approaching 15 million, and the company added more than 1 million in the quarter. That is not a dead platform. That is a platform still pulling people in. So why did the stock get hit? Because the market did not just want a good quarter. It wanted a louder future. Investors wanted management to raise the outlook. Management mostly held the line. And in this market, holding the line can feel like missing the line. That may sound ridiculous, but it is how earnings season works. The quarter is history. Guidance is the map. If investors think the map is too cautious, they sell. If they think the map hides pressure, they sell harder. Here is my skeptical view. The bears are not crazy. SoFi is still tied to credit conditions. If the consumer weakens, if loan performance deteriorates, if funding costs shift, or if growth depends too much on lending appetite, then the stock deserves a discount. This is not just a shiny app, it is a financial business, and financial businesses can look amazing late in a cycle before the cracks show. But here is the other side. SoFi has become broader than the student loan story people used to argue about. Banking, investing, lending, financial services, cross-selling, deposits, member engagement. The real question is whether one customer becomes 2 products, then 3, then a long relationship. That is how the model becomes powerful. So if you are looking at SoFi, do not just stare at the drop. Watch the member growth. Watch products per member. Watch credit quality. Watch profitability. If those continue moving in the right direction, then this decline may eventually look like a sentiment flush. But if credit starts flashing red, forget the hype. The market will not be kind. And if you are successful, share your success story in the comments so others can stay motivated. There are people watching who need to hear that discipline can actually work. Now, stock number 3 is S&P Global. And I know this one does not have the same excitement as a fintech rocket or a Disney turnaround. It sounds like a company your accountant would fall asleep reading about. But that is the trick. Some of the best businesses are not exciting. They are embedded. S&P Global sits inside the plumbing of finance. Ratings, benchmarks, indexes, market intelligence, commodity data, credit information. These are not casual tools for casual customers. These are workflows used by institutions that need trusted data, regulatory credibility, and historical depth. So why has the stock been weak? A few reasons. Deal activity has not been as clean as investors wanted. Issuance can slow when rates are uncertain. And then there is the AI fear. Whenever a business sells data, the market now asks, what happens when AI makes information cheaper? That is a fair question. I do not dismiss it. AI will pressure some data businesses. It will make basic summaries easier. It will make low-value dashboards less special. It will force customers to ask why they are paying premium prices. But here's the other side. AI may actually increase the value of trusted data. Because when everyone can generate an answer, the real value becomes knowing which answer is reliable. Proprietary data, clean historical data sets, regulated benchmarks, and institutional trust do not disappear just because a chatbot can summarize a paragraph. From recent company materials, S&P Global still grew first quarter revenue by around 10% and produced strong profit growth. The company reported quarterly revenue a little above $4 billion and adjusted earnings growth in the mid-teens. That is not a business being wiped out. That is a high-quality operator dealing with a market that wants more certainty. The guidance issue matters, though. If the forward view disappoints, the stock can stay heavy. Great businesses can still be dead money if investors pay too much and growth slows. That is the counterpoint. Quality is not a magic shield. But when a company with strong margins, deep customer relationships, and hard-to-replace data starts trading closer to the cheaper side of its own recent history, patient investors should at least do the work. This is not a quick flip idea. This is a compounding machine if the machine keeps compounding. Now let's talk Disney. And Disney is the emotional one. Everybody knows the brand. Everybody has a memory, a movie, a park, a character, a childhood thing. But the stock market does not pay you for nostalgia. It pays you for earnings, cash flow, growth, and execution. And that is where Disney has frustrated people. The company owns incredible assets, but the stock has not rewarded long-term shareholders the way many expected. Parks, cruises, studios, streaming, sports, merchandise, characters that are recognized all over the world. On paper, this should be one of the easiest companies to love. In the market, it has been much harder. The problems are not mysterious. Linear television is declining. Streaming had to move from subscriber obsession to profitability. Sports rights are expensive. Parks are still powerful. But travel patterns, international visitors, and consumer spending matter. And leadership questions have kept investors from giving the company a clean multiple. The latest reported quarter gave both sides something to argue about. Disney generated roughly $26 billion of revenue, but segment operating income slipped. Streaming profitability improved sharply, while the experiences business remained important but not immune to pressure. That is the Disney problem in one sentence. There is strength everywhere, but there is also friction everywhere. And now we have another earnings catalyst. Disney is scheduled to report fiscal second quarter results today before the market opens. So I would not treat this like a casual dip buy right before news. That is not investing. That is guessing with confidence. If the report shows streaming margins improving, parks holding up, and management giving a clear view of the next phase, the stock could earn back trust. But if guidance resets lower, if the parks commentary sounds softer, or if streaming improvement looks like price increases rather than deeper engagement, then the market may push back again. Here is the skeptical point I think people need to hear. Disney is not cheap just because the brand is famous. A famous brand can still waste your time if execution is messy. The market has already seen years of promise. It wants evidence now. but the bull case is still real. Few companies can recreate Disney's intellectual property, park ecosystem, cruise expansion, sports reach, and direct consumer connection. If management simplifies the story, improves returns, and proves streaming can be profitable without weakening the brand, then the upside can be meaningful. One more layer matters here, and this is the part a lot of investors skip. We are in a market where money is crowded into the obvious winners: AI infrastructure, mega cap tech, semiconductors, anything that can say the word automation with a straight face. That does not mean those winners are bad. Some of them are incredible businesses. But when the crowd gets concentrated, neglected names can start to matter again. Not because they are perfect, but because expectations are lower. That is why these four are useful to study together. AbbVie is not trying to convince you it is the next AI platform. SoFi is not being judged like a sleepy bank. S&P Global is being questioned because people are worried AI can attack its moat. Disney is being treated like a company that must prove the magic still converts into cash. Each stock is fighting a different argument, and the argument is more important than the price. A stock down a little can be dangerous if the argument is getting worse. A stock down a lot can be attractive if the argument is stabilizing. That is why I keep coming back to evidence, not opinions. Evidence, revenue quality, margin direction, cash generation, member growth, customer retention, management guidance, capital allocation. Those are the things that tell you whether the market is panicking or whether the market is correctly repricing a weaker business. Also, do not forget interest rates. When rates stay higher, the market becomes less forgiving. Long-duration growth gets questioned. Debt-heavy companies get pressured. Dividends compete with cash yields. And guidance misses matter more because investors are not forced to buy risk the way they were when money was free. That makes dip buying harder, but also cleaner. Weak stories get exposed. Strong stories eventually show themselves slowly, then suddenly, when the next quarter confirms it clearly. So let's bring this all together. AbbVie is a transition story. SoFi is a volatile growth and credit story. S&P Global is a high-quality data and financial infrastructure story. Disney is a brand turnaround and execution story. 4 dips, 4 reasons, 4 different risks, and that is why you cannot buy them the same way. AbbVie may appeal to someone who wants cash flow and dividends. SoFi may appeal to someone who can tolerate volatility for growth. S&P Global may fit patient investors who like durable financial infrastructure. Disney may fit someone willing to wait for a turnaround, but only after hearing what management says. The mistake is thinking every red chart means opportunity. No, sometimes a red chart is the market giving you a better price. Sometimes it is the market warning you before the bad news becomes obvious. So before you buy any dip, ask 3 questions. What changed? Is it temporary? And what evidence would prove the market wrong? If you cannot answer those questions, you are not buying the dip. You are buying a feeling. Subscribe if this helped you think more clearly, and comment which of these 4 you trust most, and which one you would avoid completely. And remember, this is for education and research. I am sharing how I would think through the setup, not telling you what to buy or sell. Your portfolio has your name on it, so do the homework, understand the downside, and make the decision that fits your own situation.